Hey guys, it's Max Convexity. Hope everyone's having a great night. Hey, I want to talk about these profit boxes real quick, and then I want to talk about a comment I received. I want to try to answer this comment. Your channel. Hope everyone's doing good tonight. I've already recorded this once, but it didn't, for some reason, there was no audio, and I don't know why. Okay. All right, this person, I don't know how to pronounce his name, but so I'm just going to say once again, the loss of millions in QQQY and JEPY reminds me of my previous controversial question. I believe today was a roller coaster day, and pretty obvious that they either make a big profit or loss. A fund manager with common sense should have put a stop loss or some risk management system in place. It's great to have a beautiful strategy, but where's the risk management? Seems they've ignored this part. Max, please share your thoughts on whether it's worth paying high fees to trust professionals, or is it worthwhile? All right, sorry about that. I had to go let Jax in. Okay, well, whether it's worth it's up to you. They do charge a high fee. They charge 1%. The way I look at it, these guys are, let's look at this. If you're just into results, I'm a bottom line kind of guy, total growth kind of guy. Since inception, this fund is up without reinvesting dividends 8%, 8.62%, the QQQY is. And that's after today's bloodbath. That includes today's bloodbath, and it includes the bloodbath last week, and it includes all the bloodbaths. So yeah, I'm happy with it. At this rate, they're going to make 21% a year. Heck, 21% a year is incredible on a covered call fund, because the one thing we know about covered call funds is they always outperform just a non-covered call fund. That's why I put this up here to compare it with the triple Qs. Usually, as far as total performance goes, it's about half. Sometimes a little bit more, but in this case, the triple Qs are up 16, but so this is up about half. The difference is this paid this paid 3 times the dividend. In fact, it did pay 3 times the dividend. So it's just a matter if you need more cash. A lot of people, the QQQ dividend isn't enough to sustain their lifestyle. So they can get the QQQYs. And yeah, they won't perform as well. They'll only perform about half as well, but they're getting 3 times the cash in their pocket. So, it's just kind of what's up to you. But as far as them doing something, I don't know what they would have done to miss today. A stop loss wouldn't have helped them out today. The money was lost overnight. By the time the market opened, they'd already lost. You might as well stay in by that point. By the time the market opened this morning, the bloodbath had already happened. So a stop loss isn't going to help you. It just comes down to these guys believe, it's not just these guys and Warren Buffett and about 75% of the investing world believe there's no edge in trying to time the market. And it's called indexing. They just believe that indexing, just owning the whole index instead of trying to pick and choose specific stocks or specific times to be in the market and out of the market, usually you perform better just owning the whole index. So that's the whole philosophy these guys come from. So yes, they're going to be fully invested at all times. It even says so in their prospectus. That's their job. They're going to stay 100% invested. And for them, invested means selling a put option every day. That gives them one-to-one direct exposure to the NASDAQ or whatever the index is they're trading. So yes, these guys will just always be invested. Like I say, is that worth it? I mean, if you want a fund that's going to jump in and jump out of the market, this is not the fund for you. And it's not just this fund. None of these covered call funds. Well, there's only one. But all of the JP Morgan funds, all of the Global X funds, all of the IWMY funds, all of the Curve funds, it's in their prospectus. They're just 100% invested at all times. That's just their business model. Because with them, their edge doesn't come from timing the market. Their edge comes from their option strategies. And their option strategies actually earn more on volatile days. So I will say this, though. There is one fund I have found, in the 3 months that I've had this YouTube channel, that has a different philosophy. That they have a different philosophy. It's BALI, B-A-L-I. And they do say right here in their prospectus, during temporary defensive periods, i.e. response to adverse market, economic, or political conditions, the fund may depart from its principal investment strategies and invest up to 100% of its total asset in liquid short-term investments, meaning cash. They're just trying to say we reserve the right to go to cash. But they're saying as a response to adverse market, economic, or political conditions. Now, what those are, that's for them to decide and not you. So, they may still not be careful enough, but because all I'm saying is they get to decide what constitutes. Like, I guarantee you, BALI was fully invested today. You aren't going to miss today's action. There's no way you're going to miss today's action with the stop loss, or there's no way. Today's just a down day. It happens every once in a while. You can't be invested in the market and not be subjected to down days. Most of the other funds were down a lot worse than. Look at. Let me see. Let me try to show this. So look at QQQY. They were down 1.3%. The market was down 1.6%. It's 0.3% different, which is a lot on a percentage basis. It's like 20%. They get 20% less downside than the market today. And that's not just today. That adds up over time. And, that's why I'm not worried about it. And that's where their edge comes from. And that 20% less downside they got was because they sold that option. If they wouldn't have sold the option, they would really get all the downside of the parent. But they don't get all the downside of the parent. They get a portion of it, and they get a portion of the upside. It's just the way these funds work. But if I get it. If that's not what you're looking for, by all means, maybe go to BALI. There's a catch with BALI though. BALI only pays 8%. So this fund pays 60%. I think the extra 52% is more than offsets the extra risk associated with this, especially when you consider it's up almost 9% since inception, even after today's big loss. And earlier this month, on the 31st of last month, we had a $4 million loser, $4.7 million loser. And that stuff's not great, but that goes into your total return. We've also had a lot of big winners. But even if you include this, look how we had 4 losers in a row last month right here. Even if you include all that, this thing's still up 8%, whereas the general market's up 16%. I mean, it's doing exactly what it's designed to do, in my opinion. But no, they aren't going to jump in and jump out. That's not what these guys do. Like I say, get BALI if you want a fund that's going to sell covered calls and then jump in and, jump out in an adverse time. But like I say, I don't think BALI would have helped you today. I guarantee you, and I haven't looked yet, but BALI was fully invested today. You can't just miss. It's easy to say in hindsight, well, they should have just put a stop loss in or something. Anyway, but today, there's nothing that would have helped today. The reason they make so much money and can pay such high dividend is because they sell options the night before and they earn all the decay that happens overnight. And there's a ton of decay overnight. Well, not over last night, but by the time the market opened, they were already down 3 million. And lots of times the market bounces after that. If they would have just had a stop loss in, you watch, if they would have got stopped out, the market would have bounced and everyone would have been mad that they didn't stay invested. So you're damned if you do, damned if you don't in a situation when it gaps down overnight big. But that's the reason these guys make so much money, is because that's the reason they're able to pay such a high yield, I should say. It's to be determined if they make money. Right now they're up 8% on, year to date. But that's the reason they can pay such a high yield, is because they take that overnight risk. That's the business model. In these covered call funds, they have their own risk management built in, and the risk management is you don't lose as much as the regular funds lose just by virtue of the option you sold. You saw today's risk management, it saved us from losing the full 1.6%. We only lost 1.3%. So that's how they mitigate downside. There's a buffer on the downside, and there's a buffer on the upside. But no, they won't use stop losses. None of the funds do it except Bally. Like I say, and Bally would be great. If Bally paid 60%, oh my goodness, you know. But I think the extra 52% yield is worth the little extra risk. But it's just, that's my opinion. But it's up for everyone to decide for themselves. All right, let's look at these profit boxes for tomorrow. All right, I'm going to do these real quick because I kind of rambled about that. These guys sold 162 puts at the 17,640 level for 90 bucks, we'll call it. Subtract 90 from 17,640, we get 17,551. So we need at least 551 tomorrow, 17,551. These guys are trying to win $1.4 million, which would take them to 2 cents negative on the month earnings. But their estimate on dividend was still around 82 cents, and they paid 85 last time. So the dividend part's hanging in there. They're gathering plenty of extrinsic, and they pay the dividend with extrinsic. Okay. IWMY. They sold 570 options in the 1975 level for $19.50. You subtract those two numbers, you come up with 1956. We want to at least close on 1956 tomorrow. All right? Preferably closer to 1975, but at least 1956. These guys are going for 1.1 million. It would take them to 30 cents negative on the month. Well, these guys have just not had a good month again. But as far as their extrinsic capture goes, they're still right on pace. You know, about 4 cents under last month at this point in time. All right, so JEPY, these guys sold 244 puts at the 49.60 level for 17 bucks. Subtract 17 from 49.60, you get 49.43. So we're looking for at least 43, 49.43 or above. That would be 420,000. And that would take us to negative 6 cents earnings on the month. Extrinsic capture so far has been 33 cents, which puts us on pace to pay roughly 59 cents. Yeah. All right, so let's look at futures. TLT's in the dumper. We don't even have to look. The last time I looked, hang on, we'll look here. That's why I keep track of it. But I'm showing that we're right in the middle of the valley of death. I mean, we're just right there in the middle of the valley of death. The good news is it is still 8 trading days until these options expire. So if we can get the price to move out of this range, perhaps up here or perhaps down here, these guys can still salvage a pretty decent month. So we shall see. That is also to be determined. Let's look at stock index futures. All right, well, that's pretty much flat. Up 7/100ths, S&P's flat. Russell's up a 1/4 point, but when it's down so far, it's probably, I mean, who knows. I say we go up tomorrow. The reason I think that is look at this. Look, the market makers didn't, I mean, we didn't get much premium for today. Usually when the market makers are worried the market's going to crater, the option prices are really high, which is good news because we sell those options, but lots of days it's the days we lose money when we have to close the options. But when the market makers expect a bad day, they charge way over 100 for the options. Look, they charged 133 this day, and look, we lost 4 million. You know, now the next couple of days they charged 100 and we made money, so that doesn't always work. But generally, when they charge something outrageous, that means you're gonna probably lose that day. However, they did not charge something outrageous tomorrow. $89 is pretty low. It's back like it was about here. So I think if the market makers are really worried about this turning into a bear market or a 2-week downturn like we had in October where we lose 10% of our market cap, something like that, this option will still be going for 100 and up, because the volatility and market is inverse. And that's why these strategies are cool, but they're also kind of like threading a needle. In a covered call strategy, you monetize the volatility, so you want high volatility, but you don't want the volatility so high it makes the market crash. I mean, because the volatility and the market, the returns are definitely inverse over time. All right, guys, I'll let you go. You guys have a good one. See you in the morning.